So welcome to the Inside Secrets. This is part of this series. I have the 12 of them that I've picked out that's free on the website, KarenRands.co. And, there's 44 Inside Secrets in the book I wrote, Inside Secrets to Angel Investing. That's a primer for investors that are getting started in investing in entrepreneurs as angel investors or crowdfunding investors, or they've been doing it a little bit and they feel kind of like they're not quite sure if they're doing the right thing. It's really, people that have joined a group that the group doesn't offer education much, or they do it every once a quarter or something, but you really want to learn at your own pace and learn more. And you just don't want to, go to, I don't know, watch a lot of videos like this. Hey, anyway, that's what the book's for. There's a resource portal that comes with it. And today we're talking about Inside Secret number 17. So ideally, the executive team has developed and documented a funding strategy that is linked to their operational growth plan, so that with funding at specific levels, they can hire personnel and complete other items related to delivering product to the market and creating revenue. Bottom line is, you don't want to invest $50,000 only to find out that they really needed $500,000 to get to the next milestone. So now in reality, unless you're a friends and family, truly a seed stage, you're not going to, the companies shouldn't just be asking for $50,000 pretty much ever. All right. They need to be, usually they're going to ask 500,000. And I spent a good bit of time in the book talking about that as a real criteria. Risk with investing in early stage companies is that they don't know how to raise all the money. And if they don't have a plan to raise all the money, they can run out of money and not get things done. And then that's just a recipe for disaster, quite frankly. And so because one of two things happen if they don't raise all the money that they actually need. They will go out of business, okay? Or they'll scramble around and try to get money on bad terms, which will affect your position in the company. Or third, they'll figure a way just to grow organically, and they'll just keep slugging it out, making a little bit of money all along the way, but not get to a point of having the exit that you're looking for. When you're looking for 27% IRR or something like that, and they take 10 years to get to 5 million in revenue, which is, most companies don't even get to, most startups don't even get to 1 million in revenue. So it's not unheard of for that. I love Hal Martin. If you know him, he runs the 10 network and was part of setting up CTAN, the Central Texas Angel Network. And 10 is the entrepreneur network, and they do monthly events. They help companies, they help investors. They've got they do all aspects of what I do in compassionate capitalism. He is probably one of the original compassionate capitalists out there. And he calls it the payroll exit. When he and I did a podcast, go find it, HALL Martin, we talked about the payroll exit and one of the things he does to mitigate that risk of that. But the payroll exit is when you, as the investors, maybe on the board, whatever, they come to the board, they ask for pay raises for the executive team because they're 5 years into this and they should get a pay raise. And then they should, except they're not delivering on what they had promised you when you decided to give them the money. And they're getting benefit by getting a payroll increase, and it becomes more of a lifestyle business than the high accelerated business that you do. Now, not to say there's anything wrong with investing in lifestyle businesses. I advise companies frequently that are not candidates for traditional angels, how they need to structure it to be something for a lifestyle in business and an exit that gives it. That's kind of when investors a bank kind of thing, or it's based off of a revenue payout instead of an equity payout. There's different things that you can do in the structure of it. If you want to invest in that business down the street, you want to do something through the interstate, you wanted something that's not going to scale to be really big and huge. It just doesn't, it's just another version of something that's kind of out there. That's that, right? So that's one thing about it. And 50 grand may be fine for that. But the point of this inside secret is they have to have done the work. When I do the reviews that I do for investors to assess a company before they spend a lot of their time, which is very valuable in the deal, one of the things I look at is their financials. And the thing you have to look at about financials, and they can be kind of deceptive, they're not your traditional financials, because they, depending on how they float on the bottom, they'll have a line item that's kind of like retained earnings. Then they'll have one that's based on their cash flow, and it'll show like negative. And then they'll have what they raise, and so they'll say it is the 500,000. So they'll put, or it's the 50,000, right? Whatever it is, it's 500,000. It's really a million. It's just, it's in those numbers that you get to start to see if they understand, because there's as that depletes, you need to be able to get to, they need to be well into a way of getting paying all their own bills before they run out of whatever that chunk of change is. And they should be thinking about ways to finance some of the stuff that they're doing, financing the equipment, financing potentially some of the advertising, financing inventory. They can finance, they can get some money from out of the contracts perhaps, but they use some of that money that's gone in and they amplify it to be like $750,000 instead of $500,000. If they're smart about what they're going to do with the money, and if they've thought through this. And then you go up into the rest of the financials and you're looking at, do they really understand what is going to be needed to hire the resources or to buy, whatever they need. They'll do some numbers that they've just sort of guessed at, and they're really not accurate. Their legal fees might be higher, likely could very well be higher, particularly if they're going to be doing patent stuff. They're probably going to need to pay good financial people. They're going to need to hire consultants. They're going to need to hire people to come in and tell them how to structure a department. If they're a startup and they've not done this before, they might need executive coaches. They might need somebody that's going to get them a license. They're going to broker them out to go get a license for something that they need. Or a lot of times they underestimate the cost of software development and quality testing. Right? You think you're going to bring it to market, this month, but you haven't factored in quality testing. They haven't factored in usability testing, right? User groups. Those should be a part of a product launch. There's a lot of things that because out of fear, they don't want to ask for too much money. Some entrepreneurs will feel like, oh my God, I can't ask for 2 million. And then some will be very bravado and ask for a lot of money and expecting it to get from sources that they're not going to be able to get. I got this guy I was advising for a minute until he stopped listening to me. He thought he needed $5 million out of the get-go, actually 15 million. And you're never going to raise 15 million. You don't have a working product. You could raise $1 million to get your product done and in the market and prove your business model, and then go raise the bigger, but you factor that in and you raise them kind of at the same time. There's like a whole way of overlapping that strategy because it takes time to raise money. But with the milestones you make on this, you make this other one easier. And sometimes, but they don't always listen. I work with companies that won't listen to me about what it is that they need to raise or be prepared to raise, or they're raising too little money. And one of the things that investors are afraid of is that you raise in too little money, because if you don't have a strategy to get the next round, you don't know when you're going to start looking for it, then you're going to find yourself running, the company running, and they hit a wall. And that's when you get into the disaster zone. So you want to make sure that they've got a well-documented funding strategy, and they have thought about the things that they're going to need, and when they're going to need them. so that they can plan their cash flow accordingly. And that takes some time to look at it. And it's not the kind of thing that just a regular accountant can look at, because they're looking at dollars and cents. It doesn't add up usually. Somebody with business acumen that's accustomed to what a startup does, or, I always ask them, where'd you get that number? And if they could point to a source for it, then that's fine. They didn't just pick it out of the air. And sometimes, you want to look at the formulas that they're using, because they might just be multiplying what 2/3% each month, right? And so those are sort of the red flags I look at in how the financials, when I look, that's the financials are something I spend a great deal of time on. So I really want to encourage you to be thinking about that. It's an inside secret. The very savvy investors spend some time looking at that. They look at a lot of that course of cash flow. You don't really need something that's further out than 5 years, because nobody can really predict that. It's really more their business understanding of financing. So it might be in their narrative. It might just be in the Q&A. Well, what happens if this happens? Or what's your contingency plan for this? Right? That's the reason why they say that adage of more investors will invest in a team and a B product over a B team and an A product, because the A team has put enough people in place, or that it might include the board of advisors, that the right people in place with the right experience to anticipate and be able to pivot when something changes in the business and they need to go to that next level, and they need to, change a direction or modify things. Nobody could have predicted COVID was going to happen. I mean, eventually there was going to be something like that, but that it was going to happen at that moment in time, right? That was something that was a black swan. But businesses that had anticipated their cash flow needs out, just like a household that budgets and saves, and they're anticipating this need for emergency funds or a line of credit that's secure that they can go into to use in short term, then that shows that they have the ability to anticipate the unanticipatable. Okay, and be prepared for that rainy day, the proverbial rainy day. So that when you're looking at it, look at their financials. Are they asking for enough money? And two, do they know how to raise the money, and when they need to raise it, and where to get it, and how to amplify the money so that they can extend it? And that's that next inside secret. So I think we'll be back on next week. But if not, if I have a guest, I'm starting to get these recorded a little ahead. And please go to KarenRands.co. Check out the blog page for other podcasts and get to the links to the different players. If you want to subscribe, if you're not, or wherever you're listening to this, please give us a review. It's really important. I didn't realize how important it was. I've been doing this a long time. I had no idea how much that was. I should have known. Now I do. Anyway, so if you like the show, please give me a review. And, you can always go and opt in on KarenRands.co on the contact page. And you'll get when you get your response back, there'll be a link to my calendar, or you can just send me an email with a question, or hop onto the videos or some of these when I check the comments on the blog, and I'll answer your questions. So thank you so much. I appreciate your wanting this information, and I hope you prosper with your move into compassionate capitalism, the compassionate capitalist movement, and onwards and upwards.